Okay, let's unpack this thing that, I mean, almost every single working adult has gone through, but very few of us, really get. We're talking about the tax refund.
Right.
And just to be super clear from the get-go, we are not talking about the document you file. That's your tax return.
A crucial distinction. Yeah. It gets mixed up all the time.
We're talking about the actual money, the repayment that hits your bank account.
Exactly. The refund is just that. It's a repayment because your tax liability, what you actually owed for the year, was less than what you'd already paid in.
Usually through your paycheck.
Usually through payroll withholding, yeah. You basically gave the government more money than they were entitled to keep.
And when we say overpaying, we are talking about, well, just massive amounts of money.
Yeah.
Not just here in the U.S., but globally. But to hook you right away, let's just look at the scale here.
It's pretty staggering.
In 2023, the IRS refunded something like $198.9 billion to taxpayers.
Wow.
Nearly $200 billion just
Yeah.
flowing back out.
That number really sets the stage perfectly for what we're doing here. So our mission in this deep dive is really tailored for you, the listener. We want to get into the nitty-gritty, the mechanics, the money, and maybe most importantly, the strategies behind managing that excess cash.
Yeah, and to do that, we've pulled together a really comprehensive global overview. We're looking at key differences in how it's all administered, the timing, optimization strategies across the U.S., Canada, the U.K., New Zealand, Ireland, even India.
Mm-hmm.
We really want to know where the money goes and how to get it back.
Exactly. And, before we dive into all the mechanics, we have to touch on this sort of philosophical question that really shapes your whole financial strategy around this.
Which is?
When you get that refund check, especially if it's a big one, are you getting a fantastic windfall? Or is it just your own money coming back to you late and, in most places, without any interest?
The interest-free loan. That idea is going to be pretty central to this whole conversation, I think. So let's start there. Let's dive into the U.S. experience first, because the history and the sheer scale of this is, well, it's fascinating.
When we're talking about the U.S. tax system, getting a refund isn't just common. Historically, it's really been the norm.
The default outcome.
Pretty much. The IRS data shows this really high prevalence. If you go back to 2004, a huge 77% of all tax returns filed resulted in a refund check.
Wow, 77%. So nearly 3 out of every 4 people filing got money back.
Which really suggests the system is, structurally biased toward over-withholding.
Well, that makes sense from the government's perspective, right? It guarantees them consistent cash flow. But even if the percentage of people getting refunds stays high, the actual dollar amount, that seems to change all the time. It's driven by the economy and, I guess, by what's happening in Washington.
Oh, absolutely. Looking at the trends gives you this incredible snapshot of American finances. Let's just track the average refund for a minute. In 2011, the average was a pretty hefty $2,913.
Okay, almost $3,000.
Yeah. By 2017, it had dipped a little, down to $2,035.
That 2011 number, though, that's a decent chunk of change. That's a vacation or paying off a big credit card bill. But the real shock, the real shakeup came in the 2018 filing season, didn't it? Reflecting what happened the year before.
That's right. That's the one. The average refund in 2018 just plummeted down to $1,865.
Whoa.
That was an 8% drop year over year.
An 8% drop in a single year. That is a fundamental financial change for millions of families. I mean, the average filer was short about $170 that they were probably counting on. So what happened? What caused that big of a drop so suddenly?
That was a direct result of what our sources call the most sweeping changes to the tax code in 30 years.
The Tax Cuts and Jobs Act of 2017, the TCJA.
The TCJA, exactly. It just fundamentally rewired how withholding was calculated. For example, the standard deduction went way up.
Which meant fewer people were itemizing their deductions.
Right. And because of those changes, the IRS updated its withholding tables that employers use. The idea was to make withholding more accurate so people's paychecks would be slightly bigger throughout the year, but their refunds would be smaller.
So people were paying less in tax overall, but the system was trying to take out an amount closer to their actual liability.
Precisely. They weren't over withholding as dramatically as they used to. The problem was communication. The IRS tried to get the word out, but, people are creatures of habit. They expected their usual big refund, and they were shocked when the checks were so much smaller.
And it's important to say the average has bounced back a bit since then. It landed at $2,878 in 2023.
It did, but even that 2023 number was a $297 decrease from the year before, from 2022. It just reminds us how volatile these figures are.
So no matter what the average is in a given year, the basic reason why people overpay, that stays pretty consistent. And you said there are two main drivers for those huge U.S. refunds that we really need to understand.
That's right. Two primary drivers.
So let's nail those down for everyone listening.
Okay, the first one is just the basic mechanics of how withholding is calculated. It's based on this idea of annualization.
Annualization?
Yeah. Your employer looks at what you earn in a single pay period and then basically calculates what your total earnings would be if you made that amount for a full 12 months. They withhold tax based on that annualized income.
Okay, so can you give us a concrete example of how that assumption can lead to a really big overpayment?
Absolutely. Let's say someone starts a new job, it pays $50,000 a year, but they don't start until October.
Okay.
So by the end of that calendar year, they're only going to have earned $12,500. But, and this is the key, every single paycheck they get from October to December, their payroll system is withholding tax as if they're going to earn the full $50,000.
So the system is taxing them based on a salary they haven't actually earned yet for that year.
Precisely. It's withholding tax at a rate that's appropriate for a $50,000 income, even though their actual income is way lower, putting them in a much lower tax bracket. So way more tax gets withheld than is actually owed, and that creates a big refund when they file.
And this would apply to anyone who was unemployed for part of the year or had a big life change, right?
Exactly. The whole system is basically designed to err on the side of caution. It protects the government's revenue by over-withholding, which in turn guarantees a massive pool of money for the Treasury to use all year.
Okay, so that's driver number one, the annualization calculation. What's the second big one?
The second major driver, and this is one that can result in a refund even if you owe zero income tax, is the Earned Income Tax Credit, the EITC.
We hear about the EITC all the time.
Yeah.
Break it down for us. Why is it such a massive driver of refunds?
So the EITC is a refundable credit, and that word refundable is everything. It's designed to help low to moderate income working people. Now, most tax credits just reduce the tax you owe down to zero. A refundable credit, though, means if the credit is worth, let's say, $2,000, but you only owed $500 in tax.
You get the difference back.
You get the difference of $1,500 back as a cash payment. This is the mechanism that creates those huge refund checks for millions of Americans, making it a critical source of income.
That refundable part just completely changes the math for lower income folks. And this whole analysis of why the money comes back, it leads us right back to that philosophical debate you mentioned.
The interest-free loan debate.
Exactly.
And this is, the real friction point for anyone who thinks about finance and opportunity cost. So if you got a big refund, let's use that 2011 average, $2,913. That money was just sitting in the government's account doing nothing for you for maybe 15 months.
From the start of the tax year until you get the check in, say, April.
Right. You have essentially given the U.S. government a zero-interest loan for over a year.
And you have to think about the opportunity cost.
That's the term. What could you have done with that money if you just had that $2,913 and put it in a high-yield savings account, earning, say, a modest 5%, which you can get today?
You'd have made about $150 in interest.
At least. And if you'd invested it, the potential lost earnings are even bigger.
So the argument is a big refund is actually a sign of poor financial planning. You willingly gave up your own money, your liquidity, and potential investment returns, all to help the government's balance sheet instead of your own.
That is the rational, the optimized financial viewpoint.
Wow.
But, and this is a really important but, there's a very strong counterpoint, and it's rooted in human behavior.
A lot of people want that big refund.
They actively prefer it.
They use it as a kind of forced savings account, right? With the IRS acting as their very strict bank manager.
Yeah. Yes. They know they're overpaying, but they also know they lack the discipline to save that money bit by bit themselves. So they prefer the security of getting that one big lump sum back every spring. They use it for big ticket items, a down payment on a car, a new roof, paying off high interest debt. That psychological security is a really powerful economic force.
And there's also the fear factor, too.
The fear of the alternative, exactly. What if you try to get your withholding perfect, you aim for zero, and you mess up? You end up owing the IRS a bunch of money at tax time, and you might not have the cash to pay. That's a huge stress.
Yeah, that would be a nightmare for a lot of people.
So for many, the guaranteed lump sum refund is just, it's better for their peace of mind than the risk of scrambling to find $3,000 by April 15th. It's a trade-off. You're trading optimal financial returns for minimal annual stress.
Okay, so if you're the kind of person listening to this who falls into that first camp, the maximized liquidity camp,
Mhm.
you want to avoid the interest-free loan. So how do you actually do that? The first step is figuring out what the optimal result even is, and you said it's not zero.
Correct. The goal is to maximize your own cash flow during the year without getting slapped with a penalty by the government. So optimally, your tax return should end with you owing a small amount of money, just under whatever the penalty charge threshold is.
Okay, so owing a little bit is actually the sweet spot.
It is. It means you have the maximum use of your own money all year long without getting in trouble with the IRS.
So what is that penalty threshold? This is the nuance that I think a lot of people miss.
Right. This is where it gets a little complex, but it's
Oh.
crucial. The penalty kicks in if you haven't paid enough tax during the year through your withholding. You generally want to make sure your payments cover the lowest of three different thresholds.
Okay, let's lay them out. What's threshold 1?
Threshold 1 is 100% of your tax from the prior year. So if you owed $10,000 in tax last year, you have to have paid at least $10,000 this year to avoid the penalty.
Simple enough.
Well, there's a catch for high-income folks. If your adjusted gross income, your AGI, was over $150,000, that number jumps to 110% of the prior year's tax.
So high earners have to pay a bit more to be safe. They'd have to pay $11,000 based on that $10,000 liability from last year.
Exactly. Okay, so threshold 2 is 90% of your current year's tax liability. If you think your tax bill this year will be $15,000, you need to make sure you pay at least $13,500 throughout the year.
And what if your income changes? And that's all too complicated to figure out.
Then you have the simple, crucial one for most regular employees. Threshold 3, $1,000. If the total amount you owe when you file is less than $1,000, you are generally safe from any underpayment penalty.
So if you owe $950, you've nailed it. You had use of that money all year, no penalty. If you owe $1,050, you might get a small penalty.
You might, and that makes the Form W-4 just critically important.
That's the tool you use to aim for that sweet spot.
It's the ultimate tool, yeah. When you fill it out properly at the start of the year, and a lot of people just never update it, it should withhold roughly the right amount of tax to get you close to that target.
So for the listener who gets a big refund every year and is just tired of it, what are the actual steps they can take to shrink that refund? What's the strategy guide?
The main lever you can pull is adjusting your withholding. You go to your employer, you file a new W-4 form. This is especially important if your financial life is pretty stable year to year and you're always getting a huge refund. You can tell your employer to withhold a little less.
And we always focus on the federal side. What of the state?
That's a great point. State withholding is totally separate. If you live in a state with income tax, you should check with your state's tax authority for their version of the W-4. You can adjust that too to maximize your monthly take-home pay.
Okay, so adjusting the W-4 is number one. What else can we do?
You should really keep an eye on the tax rates and the AGI thresholds. This is key if your income is, hovering near the edge of a tax bracket or near a point where you might lose out on certain tax credits. If you know where you stand, you can project your liability and adjust things before the year is over.
And then, of course, there are deductions.
Always. Specifically, our source material points to the medical expense deduction. This lets you deduct qualified medical costs that are over a certain percentage of your AGI. This is an area where people often overwithhold because you can't really plan for a major medical event that might create a huge deduction for you.
And finally, a strategy that kind of does double duty.
Yeah.
Savings.
Absolutely. Maxing out your tax-free retirement savings like in a 401k or a traditional IRA. Every dollar you put in there lowers your taxable income, which lowers your tax bill and reduces the chance you'll overpay and get a big refund. It's a win-win.
Okay, that's a great guide for controlling the money going in. Now let's talk about the money coming out. How do you actually get the refund and how fast can you get it?
In the U.S., you've got three main options. The fastest is direct deposit. You can still get a paper check mailed to you. Or you can just have the refund applied to your tax liability for the following year.
Kind of like prepaying for next year.
Exactly. Another form of forced savings.
The direct deposit option seems to be what most people do. And I saw something fascinating in the source material about a change they made back in 2006.
Oh, the split refund. That's a great behavioral finance tool.
Yeah.
Yeah, since 2006, you've been able to split your direct deposit refund into as many as 3 different bank accounts.
Why 3? What's the logic there?
It was a way to encourage people to save. Instead of getting one big chunk of cash in your checking account and feeling tempted to spend it all, you could automatically route portions of it. You could send some to savings, some to an investment account, and keep some for spending. It's a really smart nudge.
And in terms of speed, we've come a long way. I feel like in the 90s, it took forever to get a refund.
It could take up to 12 weeks, yeah. Now, thanks to e-filing, things are much faster. The average for a paper return is about 6 weeks. But if you file electronically, you're typically looking at around 3 weeks.
But what if you need that money even faster? This is where we have to issue a pretty serious warning about things like refund anticipation loans or RALs.
Oh, yeah. These are incredibly dangerous financial products. They promise to get you your refund in a day or two, but the fees and interest rates are they're astronomical. The source warns that the effective annual interest rate can be over 200%.
200%.
It's predatory. You end up giving away a huge chunk of your own refund just to get it a couple of weeks earlier. It's almost never worth it.
Okay, so before we go global, one last point on the U.S. system. How does the government make sure everyone gets paid, even people who don't have a traditional bank account?
That's a really important financial inclusion point. So back in 1996, a law was passed requiring the government to make most payments electronically. To handle the unbanked population, the Treasury Department partnered with a bank to create the Direct Express Debit MasterCard.
It's a prepaid debit card.
It's a prepaid debit card, and a lot of states now use similar cards to issue tax refunds to people without bank accounts. It ensures that not having a bank doesn't stop you from getting your money back.
That's a critical piece of infrastructure. Okay, let's go global now, because the U.S. system, for all its flaws, is pretty centralized. It's kind of automatic.
Yeah.
That is definitely not the case everywhere else.
No, not at all. When you look around the world, you see a lot of countries, New Zealand, the UK, Ireland, Canada, they all use what's called a PAYE system, pay as you earn.
Which is similar to U.S. withholding,
Right.
where the employer takes the tax out.
It's very similar, but the process for actually getting a refund if you've overpaid is wildly different. And in a lot of these places, the burden is really on you, the earner, to go and actively claim your money.
Okay, so that immediately fits the dynamic. In the U.S., you just file and expect the money. Let's start with New Zealand. You say they have a system that requires you to be very proactive and that it actually creates a kind of risk.
New Zealand is the perfect example of a proactive system. The employer deducts tax via PAYE. The Inland Revenue Department, or IRD, has all the info. But, and this is the key, the IRD does not automatically process your refund.
So if you do nothing, the money just sits there.
It just sits there. You have to actively request and file what's called a personal tax summary, a PTS, to even start the process.
Wow.
But here's the risk factor, and this is why you have to be so careful. If you request a PTS, but it turns out you actually underpaid your tax.
Oh, no.
A debt is created instantly. The moment you file that form, you officially owe the government money.
That is a huge deterrent. You have to be really, really sure you're owed money before you make that claim. Yeah. I can see why a whole industry of third-party helpers would pop up there.
Exactly. That's why they have tax agents. They're mostly self-regulating, and their whole job is to help you figure out if filing a PTS is a good idea. An entire industry has sprung up just because the burden of calculation is on the taxpayer.
Okay, so let's cross over to the United Kingdom. They also use PAYE through HMRC. What's the story there? Is it more about specific, complex claims?
That's right. The UK system has some automatic processes. Like, if you have a simple refund due because your tax code changed, they'll often just send you a P800 form and process it. You don't have to chase that.
And you can also claim if your circumstances change, like you get a second job or something.
Yes, but the real deep dive nugget, the big opportunity in the UK, is in making claims for specific work-related expenses. And this is a huge deal because you can make these claims for up to the last 4 tax years.
A 4-year look-back window. That's a major opportunity. What kind of jobs are we talking about?
The source material calls out people working for the Ministry of Defense, the MOD, or subcontractors in the construction industry scheme, the CIS. These people often have costs that are fully reimbursable through the tax system, but only if they actively claim them.
So give us some real-world examples. What kind of expenses are these?
Okay, so for an offshore worker or someone in the military, it could be the cost of temporary accommodation when you're working away from your home base, or the cost of food while you're traveling between different sites. For extraction subcontractor, it could be buying or hiring specialist tools, mileage for driving to different job sites, even replacing essential equipment.
So you can retroactively lower your tax bill based on these legitimate business costs.
And get a substantial refund that you would have otherwise just missed out on. This is a key difference. In the US, a lot of those itemized deductions got limited. In the UK, these specialized work expenses are still a huge way to get money back.
Okay, so now on to Ireland. Also a PA system. What's the key takeaway there?
Ireland is similar. It's a claim-driven model. The most critical piece of information here is the time limit. You have to claim your refund within 4 years of the end of the tax year.
4 years seems to be a common theme.
It is. If you miss that window, the money is just gone. It's forfeited to the government permanently, so you have to be timely.
Right. Now let's head over to Canada, which is also PAYE, but they have a feature that just completely changes that interest-free loan debate we started with.
Yes, the Canadian system, run by the Canada Revenue Agency, or CRA, it totally flips the script. The CRA actually pays you interest if they're late sending you your refund.
Wow. Okay, so that completely removes the financial argument against overpaying, as long as they're slow. But why do Canadians overpay in the first place?
It's similar reasons. Maybe a self-employed person's income drops unexpectedly, or someone just forgot a deduction on their TD1 form, which is their version of the W-4.
How fast are they?
They're pretty quick. If you e-file by the April 30th deadline, you can get your refund in about 2 weeks. Paper filers wait about 8 weeks. That 2-week turnaround is really efficient. It is. But if they're not on time, the interest kicks in. The CRA pays compounded daily interest on delayed refunds.
Compounded daily?
And that interest starts clocking up on the later of 2 dates, either May 31st or 31 days after you actually file your return.
So if they're slow, you actually get paid for the delay. That almost makes it okay to overpay, knowing you might get a little bonus if the government drags its feet.
It definitely changes the calculation. It softens the blow of that opportunity cost we talked about.
And I assume, like other governments, the CRA can still hold on to your refund if you owe them money for something else.
Oh, absolutely. They are very good at offsetting. If you have an outstanding tax balance or a student loan debt or some other government debt, they will keep your refund to settle that first. That's a pretty standard practice globally.
Okay, finally, let's look at India. The source material highlights a really interesting legal flexibility they have, which seems to focus more on compassion.
That's a great way to put it. So India also provides for refunds of excess tax, and they pay interest on it, similar to Canada. But the key legal feature is about timing and hardship. While you're supposed to file within a certain period, the law has this crucial exception built into it.
An exception for what?
Under their Income Tax Act, the Commissioner of Income Tax has the power to condone a delay in claiming a refund.
Condone a delay.
Yeah, to basically forgive the lateness. They can do this if forcing the person to stick to the deadline would cause them genuine hardship. So, for example, if you miss the deadline because of a severe family crisis or a medical emergency.
So the legal system itself has a built-in safety net. It's designed to be flexible and prevent someone from losing vital money just because of circumstances beyond their control.
It's a powerful feature, really aimed at economic justice. It's a recognition that strict rules can sometimes conflict with real life, and it shows a strong legal philosophy that the government shouldn't be unjustly enriched by a citizen's misfortune.
That's a fantastic global tour. I mean, we've seen everything from the very centralized, almost autopilot U.S. system to the totally proactive system in New Zealand, the expense claim opportunities in the U.K., and these interest-bearing, legally flexible systems in Canada and India. It's definitely not a one-size-fits-all world when it comes to tax refunds.
Not at all. And if we synthesize this for the listener, the biggest single difference is just the administrative expectation. In the U.S., the system tries to be automatic, which leads to that massive, almost $200 billion payout. It all hinges on getting that W-4 right.
But in a lot of these other PAYE systems like New Zealand, the responsibility shifts entirely to you. You have to be the one to proactively go and claim what's yours, often by filing a specific form or keeping detailed records of your expenses.
And that has a huge impact on everything else. We saw the incredible 2-week speed of a Canadian e-file, the clever U.S. system that lets you split your deposit 3 ways, and the use of prepaid debit cards to make sure even the unbanked get their money.
So if we boil it down, there are 2 main takeaways for you, the listener. It really comes down to actionable strategy. First, you now know how to optimize your W-4. You understand the trade-off. You can aim to owe just under that penalty threshold, that $1,000 mark for most people, to avoid giving the government that interest-free loan.
And second, you recognize the power of filing to claim what you're entitled to, whether that's the EITC in the US, which you only get if you file, or those work-related expenses in the UK, or just filing the PTS in New Zealand. These things aren't always automatic. You have to actively go and claim them.
It really all comes down to a personal choice, doesn't it? It's liquidity versus security, maximizing your money versus minimizing your stress.
Absolutely. And I think the final provocative thought we can leave you with is really digging into that choice of strategy. Do you take the mathematically optimized route? You aim for that perfect small amount owed, which gives you more cash in your pocket every month to save or invest.
D'accord.
Or do you take the psychological route? You consciously use the government as a forced, interest-free savings account because you value the security of that guaranteed lump sum payment every spring.
And the math is different depending on where you live. In the U.S., that lump sum is a voluntary zero-interest loan you're giving. But in a place like Canada, where the government pays you compounded daily interest if they're late, well, that changes the whole equation.
So which approach is truly better for your financial peace of mind? The one that's mathematically sound or the one that feels emotionally secure? That's the core question to mull over after this deep dive. And the answer is going to be different for every single person.